So we'll talk about revenue variances now. We talked about variances for our labor and our materials back in Chapter 9. We can also use variance analysis with our revenue information during the revenue process. We can use those for internal valuation as well. So we're just going to jump right into these variances. No real reason to explain what a variance is anymore. We should be familiar with those. So when you have revenue earned, the actual revenue you've earned is different from what you have planned or budgeted. There could be three explanations for why that is. The first is that the selling price was different than the budgeted price. It could be more, it could be less. It could be that the number of units you sold was different than the budgeted amount for selling. It could be more, it could be less, or it could be some combination of the two, right? So the first variance we have is the sales price variance, the SPV. This indicates that the difference that you get in revenue, it's due to the change in the selling price, right? We calculate it as such. You take your actual selling price, you reduce it by the budgeted selling price, and multiply that times your actual number of units sold, okay? So just like a gain, it's your proceeds less your book value, right? So this is actual versus less budgeted times the number of units. If the actual selling price is greater than the budgeted selling price, the results a positive number. That indicates a favorable variance. We sold it for more than we thought we could, okay? If the actual selling price is less than the budgeted selling price, the result is a negative number, okay? That indicates an unfavorable variance. We sold it for less than we thought we could. So, hold on a second, sorry. Now, this top section is still just the same stuff from the last slide. It's just a reminder, okay? What we want to look at here is the sales quantity variance. This indicates that when there's a difference in revenue, whether that's more or less, it's due to a change in the number of units you actually sold. We calculate that as such. The actual number of units that you sold less the budgeted number of units to sell times your budgeted sales price, okay? So it's actual less budgeted times the budgeted price. If the quantity that you sell is greater than the budgeted quantity sold, it's a positive number. It indicates a favorable variance for us. We sold more than we thought we would. If the quantity sold is less than the budgeted quantity sold, it's a negative number. This indicates an unfavorable variance. We sold less than we thought we would actually sell. Now remember, we never label these as positives or negatives. We just label them as favorable or unfavorable, okay? So this little box down here in the corner that's highlighted, this is going to be your formulas. You're going to want to write these down, take notes of them, use them when you're doing your homework. Like I said, I'm going to provide you guys with a formula sheet for the exam, but this is still going to be important for you. Don't just rely on that formula sheet from me. And then finally, let's look at a revenue variance example here, okay? So let's assume that the company that we work for budgets sales for the quarter at $1,500 per unit. Okay, so we're budgeting for 300 units in October, 350 units in November, 400 units in December, totaling over the quarter 1,050 units at a total sales revenue of $1.575 million. Okay, now we're going to assume that the actual sales for the quarter were 1,100 units at an average selling price of $1,550, okay? The revenue and variances are going to be calculated as follows. Your total revenue, 1,100 times $1,550 is $1,705,000, okay? Your sales price variance is going to be the actual sales price, 1,550, less the budgeted sales price of 1,500, times the actual units sold, which was 1,100 units. Here we see we have a 55,000 favorable variance. That means we sold the prices we got to sell it at was higher than what we budgeted for. Our sales quantity variance is the actual number we sold, 1,100, less the budgeted number to sell, which was 1,050, times the budgeted amount, okay? Here we see we have a $75,000 favorable variance. This means we were able to sell more than what we budgeted for. Okay? And we can actually reconcile our actual to budget by doing the following. Take your actual revenue. You can reduce it by a favorable variance. If it was unfavorable, you would add it back in. You're going to reduce it by your favorable sales quantity variance, and that's going to get you back down to your budgeted revenue. Okay? So any questions on revenue variances or anything else from Chapter 10, please let me know. I'm happy to answer questions and talk to you guys about it. You just got to reach out to me or reach out to the GA for tutoring.